Welcome to the Smart Property Investment Show with your host, Phil Tarrant.
Good day, everyone. Welcome to the Smart Property Investment Show. Phil Tarrant here, editor of smartpropertyinvestment.com.au. Thanks for joining us. Joined today with a guest who I've been wanting to have on the show for a little while, Ben Kingsley from Power Wealth. Ben, how are you going?
Good day, Phil. How are you?
Good. Now, I've invited you on today, Ben,
Yep.
not as the co-host of The Property Couch, which is a very good podcast, which I do listen to, and I recommend to our readers to tune in. I brought you in today as a guy who spends all day, every day, working with clients on wealth creation, primarily through property. So I was hoping to have a chat around that.
Yeah, no worries at all. Love to.
So we're recording this in between Christmas and New Year's to give some context to everyone about the time of the year and the market, and a nice time of the year where hopefully we can all take a little bit of time off and reflect and recharge for the year ahead. But I like to use this time personally to sort of do some goal setting for 2017. And for me personally, and you've been listening to the podcast, you'll know that I've embarked on a reasonably aggressive sort of growth phase in my portfolio after a hiatus of 2 years. But I'm using 2017 as a way in which to really supercharge my portfolio and buy some great assets, which I hope are going to deliver some good capital growth and also yield plays. But I was hoping to have a chat with Ben around just his view of the market right now. And I'm not talking about certain streets or certain suburbs, but just the health of the property market as it sits, any trends or themes he sees arising for 2017 that as a property investor I should be thinking about, and if there's any alarm bells that I should be sort of keeping in the back of my mind which will help shape the way in which I approach property investing. So, Ben, this is a good time to be a property investor.
Let me just get my crystal ball out.
Yeah.
Okay, start working it
You're
over.
one of those 8 balls, don't you?
Yeah, shake it around. I want to well, I mean, it's hard. Generally, I don't make, obviously in the media, as you and I well know, when we have to make comments, it's hard to make a generalised statement around the market. I'm a big believer in markets with the markets. So I think some of the big things that I'm looking at is affordability. So I'm looking at, where that ratio sits. So I use CBA have an index that they call a housing affordability ratio, and it's sort of benchmarked on around a loan to value ratio of around 80%. And it sort of shows what percentage of household income, and it's gross household income, that you're using to buy your portfolio. So, to borrow money for a particular property. So when I look in suburbs and I see some suburbs where the affordability ratio is over 45%, I go, how can people afford to actually hold on to that property when 45% of their gross household income is actually going to be spent on a mortgage if they're geared to an 80% level. Now, what's interesting about that, it's not a perfect science because we all know that that's measuring people who are already in the suburb, and we also know that that's based on 2011 census data that's been sort of indexed up until 2016. So we, as a property analyst and property investor, I'm very excited by the census results that will start trickling out come sort of, is it May?
No one's
April?
finished it, have they?
Yeah. So I'm excited by that because the big challenge you've got is that, if people are living in the suburb, that's the indication of the income that they have there. So how is that a true measure of where the growth's going to come from? So I suspect what you'll see in Sydney market is where we're seeing those ratios really high, that they'll be adjusted down. So what's a good example? Say areas like, I was going to say Strathmore is a good example of that, but Strathmore's in Victoria. What's the Strathfield? As a perfect example.
Yeah,
so it's sort of
10K's out from the CBD.
10, 15K out. I mean, it's got some really nice areas and just falls off really quickly in the neighbouring suburb. And so when you look at the ratios there, it's like, okay, well, what's going to happen is that actually the people who have just bought in there over the last 5 years have really brought the income to the table, because it is, it's a story of density, it's a story of owner-occupier appeal. There's some great schools in that area, some really nice homes. So is that the story? And that's what I'm looking at around the country in terms of, because I'm a big believer that income drives value. So, everything is still factored in by supply and demand. But if I'm looking at what actually is true demand, what I'm really looking at is people's household incomes, because I might be an interested onlooker, gawking at all these great properties around Sydney and Melbourne or Brisbane, wherever. But if I actually can't borrow the money to buy into that suburb, I'm not a statistic that's of relevance to me. So I'm looking for that true demand story. So I'm always focused in on what those incomes look like and then the demographic profiles. So, it's a long way of sort of saying, when I look at 2016, Sydney's by far the strongest economy of all the states. If we actually factor in Sydney and Melbourne, I think over the last 3 years, I think it's generated something like 60% of all new jobs in the country. Now, these are the cities, not necessarily the states. And then Mike Baird and his team have done a good job here, and they've got the economy moving. They've got some infrastructure programs that are going to make, moving around the city a little bit easier.
Let's hope so.
Yeah, well, it's getting a bit ridiculous. But we also know, same story for Melbourne. I mean, we've still got 1,500 people moving to Melbourne every week. So that's an immigration story and an interest rate migration story. We see Perth is, seeing a lot of people leave Perth to find job security. They're my big ones. I think sentiment is going to slowly shift, and I think media will play a big part in that. They don't like a balanced property market. We're either in boom or bust. So when people's confidence and sentiment changes, then I suspect it has a flow-on effect. And if we have a look at, history does repeat itself when we look at property cycles. If we look back to the 2001 to 2003 cycle, what we saw was a glut of properties actually coming on the market right at the death of the cycle. Because what's happening now is people, and we've seen it, just finish up. We're as you said, we're in just coming into Christmas right now, but we've seen in Sydney especially where people are too reluctant to actually put their property up for sale because they're too scared that they can get back in. They just don't know whether they're going to be able to afford to buy back in. So we've got a shortage of supply. We've got still good, strong underlying demand. But when we roll this cycle forward and we start to see this negative media story coming out, what will happen is there's also been investors who have been holding onto this stock, and they're sort of saying, why would I sell it this year if every week my property's going up by $5,000 a week? I'm just going to hold on to it. And this is what happened in 2003 where they held, and then all of a sudden it's like, oh, they're going down, and so everyone just started to throw their properties up there to try and cash in at the top of the cycle. So I suspect if it's true to form, we'll start to see an actual spike in supply, which will mean that the correction will be a little bit more aggressive than normal.
And is this Sydney and Melbourne you see this happening?
Yeah, mainly Sydney because it's had probably a stronger run. Certainly, I'm very concerned about the outer areas of both markets in terms of the house and land package stuff that's going on. We've seen before that people have this FOMO effect. It's a natural effect that, fear of missing out. And normally when things are looking bad, people also overreact as well. I mean, share market's a perfect case for that. When you see a correction, everyone gets out. It's the best time to get in.
So you talk about this being sentiment driven, and sentiment's a dangerous thing because most people base sentiment off what does it mean for me. It's a very emotional thing. So if they see everyone else moving and the media has a role to play, selling their properties because there's going to be a downward trend and people flood the market with properties and the consequent effect of that in terms of negative price pressure. How do you cut the noise out? And this is something I talk a lot about on the show. You've got to control the things you can control and don't worry about the things you can't control. Now, a lot of this stuff you cannot control. You cannot dictate what's going to happen in the economy. You can't dictate what's going to happen in interest rate.
Correct.
What you can dictate is how you choose to approach your own personal property investing and a way in which it meets your cash flow requirements or your goals, et cetera, et cetera. So how do you cut the bullshit out and just keep focused?
Keep listening to this podcast.
Okay.
It's a perfect example.
Is that
Well, it's stay true to form because the people who listen to, the Smart Property Investor Show are people who are actually taking an active interest in their investment strategy. The ones who usually act like the sheep are the people who don't understand the story, the substance behind the noise. So once, for people who are listening to this is the best time to hold property and potentially the best time to accumulate if we do go into a correction phase. And then it's also about understanding that there are markets within the markets. I mean, we're talking about Sydney and Melbourne here. If we're over in Perth, it still hasn't hit the bottom yet. And we've seen stock in Perth has gone up by 26% in 2016. So there is no oversupply problem over there. It's undersupply problem over there. It's a total story of there's too many properties to choose from and not enough people willing to buy them. So we will get into those cycles again, but what's interesting about the New South Wales story and the Sydney story in particular is the economy's flying. And, your state government's got some cash in the bank. They've got billions in the reserve to spend, which is, credit to them in terms of what they've done, make the hard decisions. But if they keep looking at those infrastructure pieces, then Sydney might still have a bit left in the tank. We could be seeing 2017 where there might be another 5 or 8% growth in this cycle.
I think this year, even though people are expecting it to plateau in Sydney and Melbourne the same.
Yeah.
But let's have a look at that. So it gets thrown around a lot and everyone talks about it. It's about the fundamentals of investing in property. And I say with a yawn and people go, what's the fundamentals? Everyone knows what the fundamentals are, job growth, migration, et cetera, et cetera, et cetera. As a property investor, chasing capital growth or chasing yield or chasing both, what are those true things you really need to worry about when you're investing in property? Now, why do you invest in property? You invest in property because you want the property to go up in value over time and you want to try and minimise the cost to hold that as much as possible with a good rental return or good yield on it. What would be those couple of key things that you would tell our listeners over this coming year if they're looking to invest in property, not the hold, and we recommend the hold strategy, but if you're looking to invest, what sort of stuff should you be investing in that's going to make sure that you achieve those things without being potentially victim to any of the negativity or sentiment-driven sort of downward trend in property? And this is Sydney, Melbourne discussion, really.
Yeah, okay. So if we're playing the long game, you invest in property when you can afford to invest in property. And you normally, the most successful investors probably time their investment. But if you're playing the long game, you get in when you can. And like anyone with a decent portfolio has got to have a Melbourne or a Sydney property inside that portfolio. No, in my view, it's no use in buying your portfolio totally in Western Australia or South Australia or Darwin or wherever. You've got to look at your bigger cities because these are your growth centres. These are where the wage growths are usually outstripping everywhere else, and it's where the brains trust go. If smart people migrate to Melbourne and Sydney because that's where their best job opportunities live, and that's no different. We're top 100 cities in the world by population, so these are big cities. They would be considered mega cities around the globe, and they're financial and service hubs, and so Melbourne's more probably education. And service hub, health and education, and Sydney's financial services is a big part of their story, and the best harbour in the world to live on. So I think from that point of view, if I look at those fundamentals, I'm playing the long game. I cut the noise out and just go for it. But I can still make mistakes in the cycle of the market. So where am I going to make mistakes? I think you're going to make mistakes in apartments in terms of high and medium density stuff. I've said this before.
Close to town?
Yep, close to town, but even close to some of, when we say close to town, Melbourne's effectively got two CBDs. It's almost got the CBD and it's got St Kilda Road. Here we're talking about City, North Sydney, Chatswood, Parramatta. I'm very concerned about Parramatta. Then there's Penrith. So there's all these little hubs that are popping up that I would say, based on the cost per square metre that I'm looking to pay for units in those types of things, it's a little bit harder. Now, that being said, if I make one caveat for the Sydney market is people are used to living in apartments. Yeah. Melbourne and everywhere else in the country, we haven't had that generational shift yet where, the first property you usually buy in Sydney is an apartment and then you leap up from that. In Melbourne, we're not there yet. We're still arguing. We're still fighting the good fight to try and...
So how's Docklands going at the moment? Is it still completely oversubscribed?
No. It's actually quite a balanced market down there. In fact, they've had growth, but they did have a chronic oversupply. I think it was 2006-07, and the majority of those apartments, about 25-35% of those apartments were valued under what people paid for them, which was pretty consistent. Again, I know the Sydney market really well from that 2001 to 2003 boom because that's when I was living here and that's when I bought here. I bought in 2001 in Alexandria, and I know that I could have bought into a high-rise apartment or three, and they all did their dough because in fact, at one stage I put $1,000 holding deposit down. This is going back, in my early days of investing. So fortunately, I didn't execute on that property. I got my $1,000 back, but that was in Zetlands, and now that Lego land's built and more parks all done through there. And if I look at the growth of that property, I think I could have bought that. And this is a guess, but I suspect it was sort of sitting around that $350. I could have got a 2-bedroom apartment with one car park for $395,000. I bought in Alexandria a single-fronted semi, and it's now worth $1.3 million. I think the Zetlands 2-bedroom apartments, I think, sort of pushing probably $720 now.
There's a lot of places out there now.
Yeah. So coming back to the story, I don't like them. I don't like the fringes where there's still vacant land, especially when I'm paying a premium out there because I don't have the education pool. So I've got to commute. So I'm always still looking for those rare diamonds. I'm looking for that owner-occupier appeal. I'm looking for suburbs with good status that just might be out of cycle. So, that's why we've been buying, as you know, in areas like Adelaide, and we've been buying in areas like Brisbane, and still a bit in Melbourne. But we've been out of the Sydney market now for about 13, 14 months.
Okay. And this is something that we've touched on over the last year or so in terms of it's getting a little bit more difficult for investors to access finance now. And the government probably 18 months ago now, put a lot of parameters in place to try and curb lending to investors, and that's taken a little bit of heat out of the market, and now serviceability requirements has increased quite a lot for investors. So rather than, you might be able to pick up money at 4.5%, they're actually looking at you at around that sort of 7% type mark. So with a finance hat on and looking into 2017, is it going to be harder again to get cash as an investor?
Yeah, it looks that way. And we've noticed just in the last couple of weeks, we've started to see margin creep in regards to, because
people pushing stuff up.
Yeah, I mean, if you remember, I think it was November where we saw the out of cycle interest rates, and the Pollies ripped the Big Four bank in for an inquiry as to say, you had no right to do that. And then effectively every bank in the last 2 weeks have just raised their investor loans, and basically no pressure on government. So there's a reason for that, and I think it all definitely flows into this whole story of APRA and the RBA knocking on APRA's door to sort of say, look, the levers we've got around monetary policy are very difficult now because we're at low levels. We need you to slow down the asset bubble that's potentially occurring in the residential space. So we still want to keep rates low, cash rate low, to keep business investing, because that's the next catalyst for growth in this country post mining boom. But we've got a problem. So rather than following the New Zealand model where they just try to cap LVRs, what we saw was a capping of the growth rates of what banks could grow their mortgage books by, their investor loan books by. So that was one thing. And now what we're seeing is the banks turning around to the regulators and saying, hey, we're carrying the can to help you guys. What can you do for us? And I think they're getting away at the moment with the idea that they can, obviously they've got profit pressures and margin pressures. So
gouge the investor.
Yeah, there's the word, you said it, but I don't say
I'm
it's
in the media, I could say it.
Yeah, you can say it. But you're right, it's a difficult thing for them, but that would then mean servicing. So another 20 basis points of rise, and on lines of credit it could be even higher. So you're probably talking another $60,000 or $80,000 in borrowing power with those types of numbers when you're getting up into that sort of 800 to $1 million in lending. So that's a problem. Might be an opportunity for someone to come into the peer-to-peer space and move around APRA, because obviously the world is changing. Innovation is going to come in there, and I think there will be, if the banks continue to look at investors as second-class citizens, I think there's definitely going to be an opportunity there for an astute entrepreneur to come in and basically get some reasonable funding and start to respect investors. Because let's face it, the security is exactly the same. Where's the risk? They're arguing that risk is a little bit higher because they're investors, but I don't like the idea that to stop that 5 or 10% of speculators who might be speculating in the market from causing contagion, they're also affecting the 90% of people who are doing, who are building wealth for their families. And I take offence to that, and I think there will be a business opportunity in the sort of next 24 months if people keep doing that.
I think also it's when you look at what property investors do for making affordable housing for many Australians.
Yeah.
It's replacing a lot of the job of the government, to be honest with you. But anyway, we don't want to get into that.
Don't start me on that, Phil.
Yeah,
we'll put our pipper hats on, and we'll get into a bit of trouble.
So what would be Prudential then for a property investor? And me personally as a property investor, I'm on the more conservative side of risk. I like to be able to sleep at night, and if I've got so many things to worry about, I don't want to be worrying about whether or not I can afford my mortgage. So that will influence the way in which I go about building my portfolio. And as I mentioned before, we're on a pretty aggressive growth path at the moment. But for your average Aussie investor who has a portfolio, how should you be planning for potential increases in your interest rates and therefore what you need to repay? And on the other side, structuring the way you borrow so that you're most attractive to a lender moving forward, so you can capitalise on opportunities if they become apparent in markets, if properties start decreasing.
So
Big
the
question.
first, good question. You always want to margin in 2%. So whatever your current retail interest rate is, put 2% on top of that. Because that's what ASIC has actually told all the lenders that they want to see happen. So they have an assessment rate which is 2% higher than the current rate, and that's what's caused a lot of the borrowing power. So if you had a loan with Bank A and you wanted to borrow with Bank B, 2 years ago would lend at or would look at the other financial institution at the actual rate, and that's how they would service it. So now we've got this 2% provision, 200 basis points, but I think every prudent investor should, if I'm sitting there with rates around 4.5%, I should be able to service that mortgage at 6.5%. And if I've gone too aggressive on that, well, guess what? If you're one of several or one of many, that's going to impact in terms of when you may have to sell that asset, because it's such an expensive cost to get in. You're talking 5 or 6% to actually acquire the asset. If it doesn't have time to breathe and the marketplace does plateau for 5 years, you could be exiting out of that or getting frustrated and sitting on that. And once you calculate all the interest that you've already paid, you probably, you're in the red in regards to that. So that's the first part of the answer. The second part of the question was around, I'm just trying to think of what it was.
About how you can be most attractive to lenders to borrow in the future.
Yeah, that's right. So uncross securitized structures are obviously best. And in a lot of cases, you're getting penalised for investing in trusts and complex structures. So if you're, thinking about starting a portfolio or adding to it, usually personal names are the way in which you're going to get potentially your best lending. And if you're PAYG, again, they, unfortunately for our self-employed folk, the data still reads that 2 out of 5 businesses or 3 out of 5 businesses fail, small businesses, so they don't like to lend unless you've got 2 years financials, and then they're normally conservative. If you've had a breakout yield, they'll only allow you the 20% growth on that. So that's always difficult. So I always say to people, keep them uncrossed. So you can make sure that if one property's had a really good run from an equity point of view, you can release that equity out. And then obviously you're looking for lenders who will factor in negative gearing benefits, who will factor in higher percentages of rental income as part of their servicing calculators. So you've just got to be a little bit more creative. And then there's obviously those lenders who are outside of APRA. So those second and third tier lenders are going to be the lenders of choice for these more aggressive players.
And if markets, sticking with Sydney and Melbourne, if markets do change and prices plateau or fall into negative territory, for a lot of people that's going to cause a lot of hurt. So people who are sitting with portfolios now with a LVR sort of 80-90%, they should be having a real good look at the health of that portfolio in a period ahead. For people who, myself included, I like a sort of portfolio between sort of 60 and 70%. For me, if I can maintain that position and also get growth, and obviously it's going to go up and down as you buy, but if you're buying the right stuff, you should be able to realise that position. Opportunities may become available. So as an investor like myself who looks at the market and looks at these opportunities, when do I know that things are happening where I can start spotting these opportunities? Like, where do I get that information from, or other than listening to the Property Investment Show? But how do I see things start turning and go, okay, this is it. Now's the time to be liquid. So if I was thinking of buying, maybe I'll sit out of the market for 6 months and keep my liquidity. Liquidity being equity that you can turn into cash, and how you actually turn that into cash. Depends. There's a number of different ways to do it. But what are those key indicators that I can start smelling? I don't want to say blood on the street, but opportunity. Oh,
look, it's mortgage in possession. It's mortgage stress. It's those mortgage stress levels that are going to be the first indicator, and we're starting to see some reporting on increases in that. Now, we've got mortgage delinquent rates of around 1% to 2%. Now, that's incredibly incredible. If you look around the world in terms of what that compares to in other markets, that's very handsome. I mean, I believe that the US ones, they're double digit. Anything below that. Now they've got a different model over there. They don't have full recourse lending like we do. But the reality is if that moves to 3 to 4%, the media will report that there's a 100% increase on the delinquency rates, and people will start to get a little bit concerned about that, where we've just had a negative quarter of GDP. So, if we get 2 negative quarters, that's a technical recession. So I think people will start to be a little bit more apprehensive. They'll stop spending. That'll, affect retail. So it's those types of indicators. So the things I look at from a macro point of view: business confidence, business spending, consumer spending, consumer confidence, and then I start looking at the lending rates and the level of borrowings that are going on outside of refinancing. So I'm talking about new purchasing activity. So what's new lending as opposed to just refinancing to a better result. But I think this year will be 2017 will be a year of the opportunity to shop around for your interest rates, because I suspect competition will never be better if there's the big lenders are basically saying that we'll penalise you for being investors.
So do you think 2017 is going to be a period where there is more stock on market for opportunistic investors to capitalise on? We just don't know.
Well, look, the data tells us that there's definitely going to be a huge amount of supply coming online for Sydney. For Melbourne and Brisbane, certainly in the apartment market. I mean, if you go back, 1994 was the year that there were more apartments being built than houses in Sydney. 1994. That didn't change for Melbourne until 2011, and in Brisbane it was 2013. So, you've got a generation over a decade there of where, there was more units always being built than houses. Where, as I said, we're not there yet with the Melbourne market. And it's, are you building the product that the consumer wants? So, that's going to be the thing. And when we started buying in Brisbane, we started buying in 2013 based on the affordability story. So just to give an example, the income ratio is 74% different. So in terms of median house price is 74% difference compared to only a 14% difference in household income. So you've got a 74% difference in what the median values are in Sydney and Brisbane, but you've only got a 14% difference in wages. Now the answer's somewhere in the middle. It's not one or the other, but there's an answer somewhere in the middle. So when I look at that and I start to think that, Sydney's, been rolling on for 24 months in this cycle, if not longer, I'm starting to sit there and go, okay, there's going to be pockets of opportunity, and you remember we only buy one investment property at a time, but I suspect there'll be more of those distressed sales that we'll start to see some opportunities there, and I think there will be apartment blocks that'll have 2 or 3 to go, and they'll probably fire sale those just to move their sales staff onto the next product, or the developer wants to be rid of that development, move on to their next project and tidy up the books on that one. So I suspect there could be some real buying opportunities. And I think for owner occupiers, I'd be sitting on my hands for probably another 6 months in Sydney and then seeing what's settling. I mean, one thing we will know, and the best way to know straight away, is how the first 2 weeks of auction clearance rates go. So what you want to be watching is the stock for sale, so the new listings that are coming online in the first 2. So they'll start coming online from around mid-January, and the advertising and all that will start to go live around late January. But those first 2 or 3 weeks of Feb, and then that first auction weekend in Feb, which I think is usually the third weekend, how that weekend goes is going to set the tone for your autumn selling season here. And if that is a high number and then it's more of the same.
So if it's a low number, it means that
if there's a low clearance rates, we're starting to see some fatigue.
Okay.
We're starting to see some buyer and demand fatigue, and that's so let it roll out, because then the supply, people will start to go, the media will get onto that, and it'll start to create that sentiment cycle of concern, and then we'll probably start to see a flood of properties coming on to try and max out at the top when we know it's too late. That the top, once people digest it all and all the values come in, the top would have probably then been middle of December.
Okay.
It won't have been the top then. So that's usually what happens, and then we start to see a sort of less interest, 2 or 3 bidders, 1 bidder at auctions, and that's when it's a good time to start looking to buy.
Okay. That's good advice. So to summarise, and we're not being doom and gloom merchants here. As you said rightfully at the start, when's the best time to invest in property? It's when you can afford it. So whether it's your first purchase or your 100th property that you're buying or adding to your portfolio, every market offers opportunities for the astute investor, and it's about being, I guess, forewarned, forearmed,
or
pre-planned.
being borderless. Start to open your horizons. If you're too top heavy in Sydney, maybe get one in Queensland, or get one in South Australia or something like that, or one in Victoria.
And a lot of that's going to come down to what you're trying to achieve through property investment, the maturity of your portfolio at any particular time. You might be really good on the capital growth side, you might be hurting a little bit on the yield play, so it's going to influence the type of properties you look to find. Try and keep cash up, keep liquid. You want to be able to find money quickly if an opportunity presents itself. That means having cash, whether you keep that in an offset or some other sort of facility, or you're able to draw down equity quickly. That's good, but also I'd imagine having a couple of pre-approvals sitting there in the wings as well, so you know your borrowing capacity.
Yeah, you don't want to be caught short by offering. I mean, you want to be the negotiator, so the way in which we look at it is you got to have all your ducks lined up. So you want to go unconditional on your offer, because that could be the reason why you get it, as opposed to the guy next to you. He's got 14-day finance clause. He's got all wants to settle longer. Right? Gives you leverage.
Yeah, gives you leverage. So be that guy.
Yes.
Be that guy or girl, or couple, however you want to go. Thanks, Ben. Really
Pleasure.
Enjoyed that. If you want to hear out more about Ben, you can go to empowerwealth.com.au. Correct. That website, right? And I know I've been to that website beforehand. There's lots of a lot of interesting information there that can help sort of frame the way in which you invest in property. Remember to check us out, smartpropertyinvestment.com.au. If you want to contact me, editor at smartpropertyinvestment.com.au. We're on all the social stuff, Facebook, Twitter, etc. You can follow me at Philip Tarrant if you want to know what I'm up to in property. Also, keep those reviews coming on iTunes. Really do appreciate them. 5 stars are the best. That's what we like to see. Anyway, thanks for tuning in. I hope you have a happy new year. 2017 is everything you want it to be in your property investment journey. So tune in. We'll see you again next week. See ya. Bye.